Welcome, curious minds, to the Tech Index AI Podcast Weekend Edition. This is where we blend tech, IP data, reports, and charts with the latest news in all things logistics, focusing particularly on air cargo. Our mission, as always, is to take a deep dive into the information you've shared with us, pull out those crucial nuggets, and, help you cut through the noise to get informed quickly. And today, well, we've got quite a stack of sources. We're looking at Tech Index's latest air freight updates, some key macroeconomic reports, and some pretty significant geopolitical shifts. We'll be looking at the changes just in the last few days, really, and how they might ripple out, not just for air cargo logistics, but maybe the broader macro market, too. It's complex, but here's where it gets really interesting. We'll explore those connections, like the ripples from jet fuel prices and the ever-shifting landscape of global capacity.
Indeed. We're connecting some very dynamic dots today. You've got some excellent material here that really highlights how things that seem separate, air freight rates in Shanghai, Federal Reserve meetings, even disruptions to oil pipelines, how they're all intertwined in the global supply chain. What's fascinating, I think, is understanding not just the movements themselves, but the forces driving them, especially right now when things feel so volatile.
Okay, so let's unpack this for you. We'll start with those interesting shifts in air freight rates globally this week, and there are some big regional variations. And then we'll zoom out a bit, look at the macro forces like the Fed's latest signals, and the very real impact geopolitical tensions are having on energy markets. Right, let's start with the pulse of the air cargo market, straight from the Tech Index data. The Global Baltic Air Freight Index, the BI00, it edged a bit lower overall last week, down about 1.8% in the week to August 18th, which leaves it still down over the year, but only by about 3.5% year over year. Now, sources were noting that market rates seemed fairly steady, kind of in line with those new BAI spot indices. So what does that slight global dip really tell us?
Well, that raises a really important point of what is behind that subtle global dip. Because you're right, the BII spot indices, which are purely spot rates, Hong Kong to the U.S. and Europe, they were pretty much unchanged over the last 7 days. So that suggests, while there might be some softness maybe lurking underneath in certain areas, the immediate stock market is showing some stability. It's holding its ground, sort of. But if we connect this to the bigger picture, we see huge divergence when you look at specific lanes, specific regions. And that signals that ongoing reshuffling of supply chains and capacity shifts that the Tanging X blog mentioned recently. It's definitely not a uniform trend across the board.
Right, divergence is the perfect word. Let's look at some specifics, because that's where the real story is, isn't it? Okay, out of Asia. Overall rates on those busy lanes from China to Europe and the U.S. were, quote, little changed week over week. But year over year, they're fairly flat to Europe, but down more than 10% on trans-Pacific lanes. That's quite a difference. Outbound Hong Kong, the BAI 30, that actually gained 1.9% week over week, still down year over year by almost 6%. Shanghai, BAI 80, slipped a bit, but only by 1% week over week, leaving it down about 3.9% year over year. And we also saw rates a little lower week over week from other hubs like Vietnam, Bangkok, India, South Korea. So what stands out to you in these Asian figures? Hong Kong up, Shanghai slightly down, Transpac way down year on year.
Yeah, what's fascinating here is exactly that contrast. Hong Kong gaining week on week while Shanghai slips. And those trans-Pacific lanes still significantly down year over year compared to the flatter performance towards Europe. It suggests a really nuanced demand picture out of Asia. The year-over-year figures, especially Transpac, they imply this continued rebalancing, on those longer, higher volume routes. Maybe it's evolving trade patterns, maybe more ocean freight being used for certain goods again. But the stability in spot rates, even with some regional dips, it indicates that while the market isn't exactly booming, it's not in free fall either. It's finding some kind of new equilibrium.
Okay. And moving over to Europe, the picture gets even more varied, almost messy. Rates jumped sharply on new lanes to Mexico and Brazil, also on the big transatlantic lanes to the U.S., but then they were flat to China and lower on other lanes like to India, Japan, South Africa. Frankfurt, the BAI 20, gained 1.4% week over week. That leaves it solidly up 7.5% year over year. But London Heathrow, BAI 40, it gave back a chunk of its recent big gains, dropped 10.5% week over week. Still, it remains way ahead year over year, up over 21%. Those are some pretty big swings.
They really are. And the big gains from Europe to the Americas, especially Mexico and Brazil, that really highlights shifting manufacturing hubs and maybe consumption hubs too, potentially driven by nearshoring or maybe new trade agreements kicking in. Frankfurt's solid year-over-year growth, that shows some underlying strength in certain European exports, doesn't it? But London's dramatic week-over-week drop after those big gains, that's a perfect example of market volatility. The year-over-year number is still strong, sure, but it cautions against just extrapolating short-term spikes. It tells us capacity management, pricing strategies, they're incredibly dynamic on these routes right now.
Okay, finally, out of the U.S., rates were higher week over week to China, South America, and also those new lanes to Germany and the U.K. However, the index for outbound routes from Chicago, the BAI 50, it really plunged, down 17.6% week over week, apparently dragged down mainly by a steep fall in rates to Southeast Asia. And that takes its year-over-year decline to a hefty negative 21.0%.
Wow. Yeah, Chicago's plummet is stark. It's a strong indicator of an imbalance on specific routes, particularly to Southeast Asia, as you said. Could be a surge in belly cargo capacity coming back online, or maybe a significant drop in demand for whatever typically ships from Chicago to that region, or just more competition. When you see contractions that sharp, it really raises questions about the specific market dynamics at play there and just how quickly supply and demand can shift. It has big effects on overall air cargo logistics planning.
Now, let's switch gears a bit and talk about something that, well, fuels everything in logistics, literally. Energy. The price of oil, which obviously impacts jet fuel directly, has been on a bit of a roller coaster, especially just in the last few days. We saw oil prices fall back on Tuesday, August 19th. Brent crude settled down about 1.2%. WTI dropped around 1.7%. What was driving that dip then?
Well, if we connect this to the bigger picture, the main driver for that dip seemed to be optimism around talks over a possible agreement to legitimize or end Russia's invasion of Ukraine. That was the feeling. Traders were basically betting that some kind of resolution could ease sanctions on Russian crude oil, which would then boost global supply. It's a classic supply-side expectation influencing prices, right? The market anticipates more crude potentially becoming available.
Right. Anticipating more supply pushes prices down. But just as quickly, geopolitics threw another wrench in the works. By Friday, August 22nd, we learned about a Ukrainian attack on a facility in Russia that actually suspended Russian oil supplies through a key pipeline to Hungary and Slovakia. And this was the second time this week that happened, potentially halting flows for at least 5 days, according to reports. We even heard President Trump, in a note to Hungarian PM Orban, apparently said, "Victor, I do not like hearing this. I'm very angry about it." Handwritten, no less.
Well, this really raises an important question about the fragility of global energy supply chains, especially for regions that are heavily reliant on specific pipelines, like the Druzhba pipeline in this case. So while the initial price drop was about potential supply increase, this attack is a very real, immediate disruption to supply. For countries like Hungary and Slovakia, who've, maintain ties with Russia and oppose some energy sanctions, it's a direct hit to their energy security, as their foreign ministers put it. So the market's definitely going to be watching closely to see if this localized disruption starts having broader price impacts, especially for jet fuel, given how critical it is for air cargo costs. Higher, more volatile jet fuel prices inevitably put upward pressure on air freight rates. That impacts the bottom line for airlines, and ultimately it impacts you, the consumer, or the shipper.
Okay, so beyond fuel, the broader economic currents play a huge role in air cargo demand. We just got the minutes from the Federal Reserve's July meeting. That was Wednesday, August 20th. And they revealed pretty broad support for holding interest rates steady last month. Almost all officials apparently backed keeping the rate between 4.25% and 4.5%. But there was a division, wasn't there?
Yes, and what's fascinating here is that internal debate. While almost everyone supported holding steady, two officials, Governors Waller and Bowman, they actually dissented. They wanted a rate cut. And the minutes highlighted a key worry among officials. Basically, how importers, retailers, and consumers are going to split the cost of higher duties on imports to the tariffs. A majority apparently view the chance of higher inflation from these tariffs as the bigger risk compared to the risk of weaker employment.
And that directly hits logistics, doesn't it? Tariffs raise import costs. That influences demand for freight, both air and sea. And then the plot thickened even more at the Jackson Hole Symposium. Just yesterday, Friday the 22nd, Fed Chair Jerome Powell signaled a possible interest rate cut coming up at the next meeting in September. Investors apparently reacted immediately, quickly bumped up bets for a quarter-point rate cut, sort of tearing up their previous forecasts. Powell cited rising risks to the job market, but also noted that inflation remained a threat, particularly, again, from tariffs. It sounds like they're walking a tightrope.
It really does.
Yeah.
This raises the question, what's really behind Powell's shift, or apparent shift? He acknowledged this curious kind of balance in the labor market. He sees downside risks to employment rising and thinks they could materialize quickly. But at the same time, while the baseline assumption is that the inflationary impact from tariffs will fade, he warned it's also possible that the upward pressure on prices from tariffs could spur a more lasting inflation dynamic. Again, That uncertainty is the real challenge. If the Fed does cut rates, the aim is to stimulate the economy, which could boost demand for goods and, by extension, air cargo. However, if inflation from tariffs sticks around, that could dampen consumer spending anyway, creating a drag. It's a tough balancing act.
So a potential rate cut to help the economy, but tariffs remain this big unknown, casting a shadow over inflation. And the stock market, well, it reacted as you'd expect to these broader signals and worries. On Wednesday the 20th, the Nasdaq and S&P 500 both closed lower. Investors were apparently selling tech stocks and moving into less highly valued sectors. The S&P 500 down about 0.25%, Nasdaq down almost 0.7%.
What's interesting there is that sector rotation. Money flowing out of tech and into areas like energy, healthcare, consumer staples. It reflects investor concerns about those really high valuations in tech, partly maybe fueled by OpenAI CEO Sam Altman's comments about AI stocks being potentially in a bubble. And there was also an MIT study showing many tech companies are actually struggling to translate AI investment into real profits yet. So this broader market sentiment, driven by the Fed outlook and these valuation concerns, it impacts consumer confidence, business confidence, and that in turn influences overall trade volumes and even the types of goods being shipped by air. And those higher tariffs the Fed is worried about, they directly influence the cost and profitability of importing goods, affecting demand across all logistics sectors. It's all connected.
So wrapping this all up, what does it mean for you trying to navigate this really complex world? We've seen an air cargo market that's, well, globally a little softer, but with these really stark regional differences, plummeting rates out of Chicago, but a vibrant transatlantic market. We've watched oil prices jump around, reacting to both hopeful peace talk whispers and immediate real supply disruptions, reminding us just how quickly jet fuel costs can shift. And underneath it all, you have the Federal Reserve carefully weighing employment risks versus inflation risks, with tariffs casting this long shadow. And all the while, the stock market's doing its own complex dance.
Yeah, if we connect this all back to the bigger picture, it's just so clear that air cargo logistics isn't operating in a vacuum, not at all. It's a highly sensitive barometer, really, of global economic health, geopolitical stability, monetary policy, everything. The nuanced movements we see in the TAC index data, combined with the volatility in energy markets and the strategic thinking of central banks, it all converges to create the landscape for trade.
It's a really powerful reminder that, every ripple in one part of the world creates waves somewhere else. So for you, the learner, the key takeaway really has to be that vigilance and adaptability are just paramount right now in trying to understand global supply chains.
Absolutely. And maybe this raises an important final question for you to ponder. As the Fed potentially edges towards rate cuts, even while these geopolitical tensions keep disrupting energy flows, what do you think will be the most significant, maybe unforeseen, impact on global air cargo capacity and demand in the coming months? Will we see a surge in specific regional lanes becoming the new hotspots? Or will this reshuffling of supply chains become even more widespread, challenging our whole idea of traditional logistics hubs?